So let's talk about an induced breakout sweep. So the first thing is you want to be in line with the trend. This is really the bread and butter. And the easiest way to identify a trend is simply your higher highs and higher lows. So this is an uptrend. You have a swing high. Now you have a swing low. Now you have a higher high. Now you have a higher low. Higher high, higher low, higher high, higher low, and so on, so on. So let's talk about this setup. So here we are in a bearish trend. And price makes a swing high. So now price breaks that swing high and comes back inside of the range, forming another swing high. So what does the retail trader think in this moment? They think that this is a change of character and the bearish trend came to an end and now price is going to be bullish. So now what happens next? Price breaks that new swing high. So what are the retail traders or even smart money traders doing? They're ready for an entry. They're ready for a discount entry just for price to go against them. So why did the bullish entry not work? The main reason is it was counter trend. 95% of traders lose their trades simply because they're trading counter trend. And we are here to take advantage of their silly mistakes. Before you proceed, please make sure you like the video and leave a comment. This helps us continue giving out these free lessons. So let's cover the basics in this example, and in the second example, we'll go a little bit more comprehensive. So what do you have here? You have an overall down trend. And here you have a swing high. Remember, the trend is bearish. So now you have a break of structure. So let's see if price comes back inside of the range. Now price came back inside of the range. So now we can mark our new swing high. So now we have another break of structure. So what is this telling the retail traders or the uninformed smart money traders? This is telling them that price is now in a bullish cycle and price is going to continue to the upside. So now what are they waiting for? They're waiting for a retracement. And where would their retracement be? They would look at a discounted entry, which would be right here. But trading the induced breakout swing, you're taking a short position. You're going against the majority. And then you're targeting the levels of extreme. So as you can see, price is failing here. And now where would you put your stop loss? Right at the next level of rejection. So right here, this would be your stop loss. So the main characteristics of an induced breakout sweep is that when you're in a downtrend and you confirmed your downtrend, when price breaks structure to the upside, comes back inside of the range, and then breaks the structure again, this phase here is the inducement. Why is this phase the inducement? Because it's inducing traders into taking a long position. It's trying to convince you this is a change of character. Even though on a macro, overall, you're in a bearish trend. So the trade against a overall bearish trend wouldn't make sense because you're trying to stop a higher time frame momentum. But what price would try to do is on the micros, it will try and tell you that there is a change of character by giving you one break of structure and a second break of structure to a point where you are looking for a retracement. So the way we take advantage of this, we anticipate that price is overall in a bearish trend. And if price is in a bearish trend, it would make sense for us to continue going short until the trend actually changes on the macro. So when price does retrace, a lot of smart money traders are taking buy positions here. This is the most basic order block entry ever. And what happens is price goes against them. So what we're doing is we're trading inverted. We're doing the opposite of what everybody else is doing. We're trying to get into an entry once the smart money traders get stopped out. So now if it was a bullish trend what you would see is a break to the downside and price coming back inside of the range. So what do you have here? You have a break to the downside and a bullish trend, but your micro is showing you a bearish signal. And then price breaking that low again. So what happened here? That's two signals to the downside. So what are the smart money traders doing? They're looking for a short position. But what are we doing? We're looking for a long position after the failure. Why? Because the overall trend is bullish. Why go against the trend? Let's take a look at this example. So what do we have here? We have a major breakup structure. And it wasn't a purge because price did break this structure with velocity. It wasn't a break and popping back inside of the range. So what can we say now? We can say that the order flow is bearish. Now let's mark a swing high. Why are we marking a swing high? Because we know any move to the upside is more than likely just an inducement. It's a trap to induce traders to taking a long position. What do we have here? A break of structure. Let's see if price comes back inside of the range. Now we can mark our second swing. And you got to look at it from a retail trader's point. So you have a swing high, price came down, gave you another swing high. So now if price breaks this swing high, they anticipate a higher low and for price to continue to the upside. But what are we waiting for? We understand that the overall order flow is bearish and we're going to take advantage of that. So now, a lot of traders are loading up an entry right here. They're loading up a buy entry right here. But what are we doing? Right below where they enter, we're looking for a short. And now you're in the trade. Where would be your stop loss? It would be your next level of rejection. It would be right here. So this is your stop loss. And where are your targets? Somewhere around that 2-to-1 range. So let's look at an example where the trap is internal. So in this example, your order flow is bullish. Why? Because as you can see here, you had a break of structure, which was a purge, be your buyers getting trapped. Now that your buyers were trapped, price retraced back inside of the range. Price retraced back inside of the range to grab orders in the discounted level to continue the bullish cycle. So now that we know this and price did reach our extreme zone, what do we know? That price does want to break out. Price wants to be bullish. So this move to the downside is a trap. So understand it. This move here is a trap. This order block here, taking this order block short, price is more than likely not going to continue deep in the range. Why? Because we already visited discount and the order flow now is bullish. So when it's an internal trap, and here's an example, price will reject at this level. What is this rejection at this level tells you? It tries to induce you into taking short positions. It gave you multiple tries. So in case you didn't get in right here in a sell, price will give you another chance to get in another sell right here. Price is begging you to take a short position. But we know that the order flow is bullish. So what do? We look at a long entry right above this level to take it back to another form of extreme. As you can see, price gave you one chance, two chances to get in a sell, even giving you more clues, trying to give you a short move right here. And boom, once price reached this level, it completely exploded and hit our TP. Hope you guys enjoyed this video. Please make sure you like the video and leave a comment.